Hey, this is Andrew Kuhn, and you're listening to the Focus Compounding Podcast, the podcast where Geoff and I talk about actionable stock ideas, timeless investing concepts, and the overall way that we think about investing at Focus Compounding Capital Management. Go to focuscompounding.com and enter in your email to get a free watch list from Geoff every other week. And be sure to check out all of our other work where Geoff writes about stocks at focuscompounding.com. I upload how-to investing videos on YouTube, and we both manage capital for investors at Focus Compounding Capital Management. Thanks for listening, and be sure to subscribe to follow along. Podcast. I'm gonna do a jumping jack beforehand. This is how I get excited. Welcome. How's everybody doing? Hope you are doing well. My name is Andrew Kuhn, Focus Compounding, sitting next to Geoff Gannon. Geoff, how's it going today?
It's going very well, Andrew. How's it going with you?
It's going great. We hope it's going great for everybody else as well. Hey, if this is the first time that you are tuning with us, this is my Twitter, @FocusCompound. There's me. There's Geoff. Be sure to follow me on Twitter. This is the best place to get all the information, all the content that we put out on the internet. We hope that you are definitely getting a lot out of it. You know, I was thinking about this the other day because we just passed our 2-year anniversary. Okay. I've learned a lot from the podcast. I know a lot of people listening have learned a lot. Have you learned a lot? Or is this just kind of something that you just, do? So you're just really explaining, stuff that goes.
No, I learned a lot from the podcast.
Yeah. They say teaching is a great way of learning, believe it or not.
Yeah. No, I mean,
sounds like an oxymoron,
we talk about things
true.
And we get an idea for like how you get a better idea for how you really feel about something when you have to kind of explain your thinking about it, because a lot of these things are stuff that we'd be doing in the fund and the manager accounts, but we wouldn't necessarily be talking about how we calculate whatever we do, or and then of course the people that we talk to.
I framed this picture, guys, for Geoff and myself. 2-year anniversary. Thank you so much for following along. If this is the first time you're following us on YouTube, hit that subscribe button, thumbs this video up, leave us a rating review on the podcast. That helps spread the word. And we are going to continue to educate, and obviously that helps push out our content. So we're super thankful for that. This is focuscompounding.com. You can join the Gannon Gazette for free. Enter in your email right here. And if you are a premium member, and we're actually simplifying the website right now, you could get access to stocks A to Z. And there's a bunch of different stocks on here. And we're actually going to be polling some today because we're going to be doing just, talking about intrinsic value and how we think about valuing companies. And we're going to be using quickfs.net. And we're going to pull some companies from here. But before we do that, if you are going to be in Omaha this year, Geoff and I plan to go. If you're a prospective investor and would like to potentially meet up with us to learn a little bit more about our money management services, email me, andrew@focusedcompounding.com. Again, that is andrew@focusedcompounding.com. Alrighty, so what's a good stock we should pull to put in quick FS? Why don't we start with OTCM?
Okay.
We've talked about this before.
OTCM is a pretty easy one to do an intrinsic value calculation for.
Okay.
Mathematically, it's easy.
Okay.
So, although it may be controversial, but it's easy. So people ask things like, what's the right PE ratio for a stock or something? And the answer is, it's not that simple. A company like OTCM, if it grows, can have a very, very high PE ratio because it doesn't, as you'll see here on the Quick FS page, really need to retain earnings. So if we just look, we can see that what was the lowest year's return on invested capital?
Let's see.
Excluding any negative.
Any negative. Yeah. 83%. Looks like. Yep.
Yeah. So that just gives you an idea that obviously they can't compound at that rate. So it's just a question of how much they grow, and then that growth is basically free. And the reason for that is they have float. This is a business that has like subscription revenue that they get up front, and it's a service business. It's not investing in inventory and stuff like that. So it's a question of just how much it grows. So it's sort of like you're getting a perpetual coupon, and then you have to assess the riskiness of it and all that sort of thing. But you basically just say, okay, how much is my yield now and how much is it growing? So let's look at that. The stock is at $33.50 or whatever it says in this last close. Yep. Or we could do it off enterprise value and things like that if we'd rather. Enterprise value is a little... Let's not use enterprise value because they have float. So let's instead use, we could just use enterprise value because that's the thing they have here. So enterprise value to free cash flow is 16.6, which means that your earnings yield basically on a free cash flow basis is going to be in the range of like 5 to 6%.
Yep.
Right. So you have like a 5 to 6% coupon. So you could compare that to like a bond yielding 5 or 6%. But the difference is that a bond yielding 5 or 6% is never going to grow that coupon
go
over
up,
time
sure,
for you.
Yeah.
Whereas this stock will. And so let's look at like the growth in it. We don't have the CAGR, but we do have like revenue growth that you can just look at in terms of how much it's gone up each year. And
So from 2009, 2010, 8%, I'm a round up, a round down, 9%, 8%, 1%, 18%, 19%, 2%, 7%, 9%.
And here's the part that's going to be controversial. So basically, the correct earnings yield that you should be willing to pay, the correct free cash flow yield you should be willing to pay for this, is going to be your discount rate, which we'll assume. So Buffett came out with a letter recently, and he showed that from 1965 to today, the S&P 500, which uses the yards to compare Berkshire's compounding against, compounded at 10% a year when you include dividends.
Yep.
So we're going to use that as our discount rate, okay, as our hurdle that we have to clear. So you take that 10% number, and then you subtract from it the growth that it has, and that will give you the free cash flow number that you cannot pay, the free cash flow yield that you cannot pay more than if you want to buy the stock. So the intrinsic value that way. So in theory, this creates a problem. If the company is growing more than 10% a year and has infinite returns on capital, we can't value it. And that's just basically true. We just can't. And that's not just a mathematical thing either. I think that while it is true that it's a mathematical fact that we can't value it, it's also just that it's too hard. The answer is it would be incredibly valuable. You'd be willing to pay a very, very high price versus any sort of earnings or something today for something that's growing at more than 10% a year while not requiring any retention of earnings.
Okay, so let's unpack this, okay? So you said 10% discount, right? Right, the hurdle, right?
Right.
And that you're thinking about that is as your opportunity cost, right? And the S&P 500, including dividends, long-term average. Okay. And then you said that you want to take that number and subtract the growth.
Yes.
So let's say you use, I don't know, let's just use 8%.
Okay.
Or 9%, whatever you want to use.
All right. So it's going to become hard if you use numbers that are that close to 10.
Okay.
So here's what's going to happen. If we use 6%, let's say, which is maybe a more realistic number or whatever, if we use 6% as the number that we feel confident in, and of course they've done more than that in the past, but let's say we use 6% as that number, then we're saying that 10% minus 6% is 4%.
Yes.
We can pay 25 times free cash flow.
Got it. So you flip it on its head.
Yeah. Now, 7% might be more likely, in which case we could pay 33 times. Right? Because that's 10 minus 7 is 3, and we're flipping it, so we're getting 33. As I said, as you get close to 10, you have the problem that you're going to get 50 times free cash flow at 8% growth. And at 9% growth, you're going to have it suggested that you should pay 100 times free cash flow. Is that right? Well, yes and no. I wouldn't pay that much. But yes, it's correct that if something can grow as fast as the market or faster while retaining no earnings, if that's true, then you get a very, very high number. And so you're basically going to get numbers that say you should buy the stock at any price almost. That's not right. There's some price at which you shouldn't buy it, and you have to do these projections far out into the future. I think the big issue, of course, is how far out you project the growth. So I don't disagree if someone's saying, well, might this company grow 8, 9, 10% a year for the next few years? Yes. But what we're thinking more is what do we think it'll grow for 10 years? That's kind of our minimum thinking, but even beyond that, 20 or 30 years, right? Because so it might really be able to grow at let's say 5% a year for all that time. If it does, then you have a very simple number, which is 10 minus 5% is 5, and then 20 times free cash flow. So it'll be worth 20 times free cash flow. In reality, it's probably worth somewhat more than 20 times free cash flow because it'll grow faster than 5% for a while, and then eventually it'll grow as slow as 5%, right? But it's that overall number. So the theoretical part of what we're talking about is it's a number that's very, very stable for a very long time.
Yeah.
A lot of people, when they do a DCF, do this thing where they say it's going to grow a lot now, and then
it's going to trickle off.
And then in 5 years, we cut that down. So it'll grow 20% a year for the next 5 years, then 10% for the 5 years after that. And then they find a terminal one where they say it'll grow at 2% or something. That makes the math very easy. But it doesn't work for the sorts of things Berkshire invests in, because he likes to buy things that will still be growing at nice rates in 10, 20, 30 years, And so that has a big impact on usually the terminal rates that you use for a great company are too low that people put in their DCFs.
Yeah.
So, but the problem is, of course, if you use the rates for things that are more upfront, the next few years, then you're going to get values that don't even allow you to figure out what the company is worth. The answer here is this is worth a very high multiple of free cash flow. So it also depends on the durability and things like that. But this would be we're using an example of a company that it would be hard to think of a company that deserves a higher free cash flow multiple than something like OTC.
No, why is that?
Because it grows most every year, and it doesn't require any retained capital to grow.
Generates float.
Yeah.
As you can tell, if there's ever a negative return on invested capital, That's something that should definitely pique your interest.
Right. So like an EV to sales of 6 times is incredibly high, but this is a company that's averaged a 25% free cash flow margin and growth that's faster than the market and all those sorts of things. So it would be a high number. I think we talked on a podcast before that the number I would pick is probably 33 times, if I was being honest, not like conservative. We don't buy stocks on the basis of an honest appraisal. But if someone came to me and said, we have a dispute between two parties on how to price OTC market stock, imagine it's not publicly traded. And they came to me and they said, we need to transfer from one person to the other. What's the right price to use? 33 times free cash flow, I would say.
Interesting. Okay, let's pull another one from, let's use Omnicom. You're familiar with that company?
Yes, this is going to be the opposite. So,
Omnicom Group, $16.7 billion company, currently trading 12.5 times earnings. On an EV to free cash flow basis, it's about 10. Revenue's gone from $12.5 billion in 2010 to $14.9 billion in 2019. That's a 10-year CAGR of 2.5%. Free cash flow is right around 1%, a 10-year CAGR, and EPS is 9%.
So here's the opposite thing happening, which is a very similar business to the one we just looked at. It generates a huge amount of free cash flow relative to reported earnings. It generates float. Ad agencies usually pay they usually receive payment a few weeks before they end up paying for what their billings. So that means that they're going to have a large amount of free cash flow relative to revenue that you see. Their revenue is a small fraction of their billings. So just like anything else, it's a timing thing. And that means that they have a constant supply of float when they're growing. Now, the float grows with it. But the problem here, as you can see, is where's the growth? There hasn't been growth. Now, there has been EPS growth, right? So if we look down at the EPS growth line, you can see growth there, or you could until very recently, by buying back their own stock, right? So that's the problem that we have here. So the returns on capital for the business itself without acquiring anything are very, very high, like the actual incremental investment, because it doesn't require any investment. So it's practically infinite in the sort of organic growth of an ad agency. But organic growth is down to like nothing. So we're not going to get a number that's like 33 times free cash flow here. Why? Because it's not going to grow that fast. So let's do the same sort of applying the idea that we had before.
Sure.
Let's take 10% because that's what the market has done over the last 50 some years.
Yeah.
And let's subtract out what we think the growth will be. Well, their biggest growth.
And what's growth?
So
everyone will ask that. What's growth? Growth in revenue? Growth in EPS? Growth in cash earnings? Free cash flow?
Growth in revenue here.
Now, why?
Because I think that's the best estimate. You could use growth in revenue, gross profit, free cash flow, any of those things. It's the least cyclical number that we're going to have here. We're measuring over the entire period. We could estimate it through different ways by looking at the revenue growth of what it's been before. I like it better than any other thing that we're going to use. We have to avoid using per share numbers because this company buys back stock. So that has to be avoided. And then we don't want to get changes in the margin affecting our numbers. A lot of people want to use earnings growth or something like that, or dividend growth. A lot of people use dividend growth because there's a model that's based on that. But that's not a good approach, because although it might be showing you the dividend growth, it's not showing you the number that's most likely to show how their capacity to grow dividends in the future. Right? Same thing here. If their earnings grow a lot because they recovered from a cyclical bottom, that isn't really that helpful now going forward. So like, for instance, what was their operating margin in 2010?
In 2010, it was 11.6%.
And what is it now?
13.9, 14%.
Right. We don't want to count that part of it. We just don't want to. So that's why earnings have grown faster than some other things. We don't want to count the margin expansion. So what we have here, I think, is probably using something like revenue growth. I think that, honestly, something like Omnicom is not likely to grow faster than inflation. Organically, it may acquire some things and stuff, but I just don't see the ad market growing much faster than that.
Okay.
So the ad market overall might grow as fast as like GDP. That's more likely, but those things could go to things like Facebook and Google and stuff, and less so through ad agencies. And
okay, so we'll take the 10% hurdle rate.
Right.
All right.
And then I say like inflation, 2 or 3%. Okay. So we have 2.5% as the 10-year CAGR on revenue. So I'd say use that. Now there's currency stuff and all sorts of things when you look at a company like this, but let's use that 2 to 3%.
Okay.
So 2 to 3% would mean we take 10 minus 2, or 10 minus 3 means 7 to 8%.
Yeah.
So we would need a 7 to 8% free cash flow yield.
Okay.
Right? And a 7 to 8% free cash flow yield is going to get us a number of around like 12, 13, that number, 12 to 14, something in that
times EV to free cash
times
flow.
free cash flow.
Yeah.
Right. So similar to a PE. So, and actually what's the stock's PE now? It's 12.5.
Yeah.
EV to free cash flow is lower than that. You can use something like EV to sales is probably better, because you just use the long-term free cash flow margin or something like that. So we're getting a number that isn't that different than where the stock is today. But by the way, that's using a 10% discount rate.
Yeah.
If the S&P 500 doesn't do 10% a year for the next 10 years, then Omnicom would probably outperform it. So you always have to be careful about the discount rate you're using. We're using a discount rate based on the last 50 years of returns. The market's more expensive now.
And when it really comes to handicapping a stock like this, well, I mean, what do you're betting that the market's pricing it incorrectly.
Right. And there can be changes based on your estimates of things. I wrote a report on Omnicom a few years back, and I would have estimated the intrinsic value of the company as being higher than I am now, because I believe that the long-term growth rate is lower now than it was. I don't believe the profitability is different or things like that. I just believe that the growth rate will be lower than I thought it would be. So I thought it was a number that would be higher than what I'm now estimating. So you can do that same math of like 10 minus 2 to 3%. I would have been saying 10 minus 3 to 4% or whatever, whatever it was before. Yeah.
Interesting. Okay, what about, I'm going to put like a disclaimer when I tweet this out, be like, warning, there were no DCFs used in this video and podcast. Psychomedics?
Okay, so we can use psychomedics. So this is another free cash flow one though. So,
Would you rather do like more of a bank one?
well, I just feel, no, I mean, we could do something that's asset based or whatever, or something that isn't, growing. Psychomedics has the same problem again, or problem. It's a good thing that all these companies have, that they have very high returns on capital while having a lot of free cash flow conversion, high free cash flow conversion. So basically, these depend a lot on growth. That's what you learn from doing this. When you have a very, very high return on retained earnings, your estimate for how much value you think the stock has is incredibly weighted to how much growth you think it's capable of. So that's the problem here. If you think, so they're going to lose some of their Brazil business and stuff, or all of their Brazil business, we can factor that in. But basically, if you think that the company is going to grow revenue as fast as they did the last 10 years, then it's cheap, right? So the last 10 years, they grew 6 to 7% a year. But we're assuming that that's not the case, because a lot of that was from Brazil. So if we assume that it's like more closer to 0, 1, 2%, then again, we're getting the same thing. We need free cash flow multiples of close to 10 or something like that. So it's basically that same number that I'm saying over and over again with these, which is you value these things like perpetual bonds when they're based on free cash flow that way. That's different from things that need a lot of assets. So maybe we pick something that needs a lot of assets, like stock. Just go to the stocks A to Z page and let's see. Let's see what people. Okay, Stella-Jones. Yeah, let's do Stella-Jones. That's fine. Because Stella-Jones is a good example of a company that will grow a lot, but has some capital issues where it can't earn a very, very high return on capital.
All right, Stella-Jones currently trading 16 times earnings, 42 times EV to free cash flow, 1.4 times EV to sales, 10-year CAGR of 18.6%, going from $411 million in 2009 to $2.1 billion in 2018. What's significant about that is the 10-year CAGR on assets is about 18% as well.
Yeah.
And then EPS has grown about 13% for a 10-year CAGR.
Okay, so this is the part that might surprise people, which is this growth is so much higher than the growth we saw in the other companies we looked at.
Yeah.
Right? It's higher than OTC markets and all that. And yet I'm going to say it doesn't deserve as high a multiple of things like earnings and stuff. So why not? Because it needs to retain more capital to do it. So if we look on their return on equity, this company uses debt. That's part of it. Yeah. So if we use return on equity, we're seeing that the 10-year median is 17%. So the issue that comes up here is that the difference between our discount rate, our hurdle rate, whatever you want to call it, of 10% and the 17% ROE is meaningful. They're creating value when they reinvest, but it isn't infinite or anything like that. So what you're going to have happening here is a question of how much they retain and how much they grow is not going to matter. The growth isn't going to matter quite as much to the value of this company as it did in the other cases that we gave. So I would use something like earnings here, to be honest. I analyzed this company, and I think the free cash flow thing, it could be kind of confusing. The company isn't run to generate free cash flow. It's run to keep increasing its assets all the time. A lot of it goes into inventory of timber that's going to be used, that's going to be made into utility
railroad tracks and stuff.
And
tracks.
For railroad tracks and utility poles. And so it has to season for the better part of a year. So there's a lot of wood just sitting around that this company owns. And that's why they returns are the way that they are. So let's look at the long-term growth in things like EPS. Okay, right? So what has been the long-term growth in EPS?
It's been 13%.
Okay. Operating margin is similar in the beginning and end?
Yep. No. Operating margin was actually 10.5 in 2009, and it's 9.7. And so similar. Yeah.
So there's been a change in taxes because this company, although Canadian, does a lot of U.S. business. So I would say that's pretty stable overall that we're seeing. So we can use the historical growth in earnings per share, but you have to understand that if we do that, that's all that you're getting is that growth, right? So the question is, you have a P/E ratio, and then you can do this pretty simply, probably. I would say you take the P/E ratio, right? That's like 16 or something. And you ask, what is a normal P/E ratio this company should trade at when I sell it at some future point in whenever? So we could say that's 10 years from now, 20 years, 30 years. So you can do the math whenever you want. You have to pick a normal P/E. So like based on the history in the US and stuff, let's call that 15 because that's a round number and it's close to what the average has been. So if we take like 15, what you're saying is how much can they grow earnings per share? And then what will the PE be at the end of this period? And the end of the period PE is going to be a little bit lower than now. So, but over an infinitely long holding period, that won't really matter. So your return is going to be very, very close to the earnings per share growth rate. So you basically just have to calculate earnings per share growth here and then take that number and compare it to your 10% hurdle rate, right? If that number is going to be below your hurdle rate, then you're going to end up with an intrinsic value that's below what we were just talking about here.
Okay, so let's say it's 13%.
Right, so it's 13%. So then you have a value that comes from the fact that you're going to have something that's compounding at 3% a year going forward more than what your discount rate is here, right? So in essence, it deserves to trade at higher than a 15 PE, okay? So it's going to deserve to trade at higher than a 15 PE by probably about 1/3, so probably about 20 times, I would guess. So about 20 times earnings is probably the right price for this. If you believe in that earnings per share thing. This is hard because they're using debt. I think it's okay that they use debt, but they're using debt and the company's gotten bigger over time. So I'm not sure you can project the same earnings per share growth in the future. But look, revenue, assets, all that stuff grew even faster than earnings per share.
Yeah.
So it's very possible. So you have a number that is greater than 10%. Now notice if we had an earnings per share number, this is what might surprise people. If we had an earnings per share growth number that was below 10%, that actually would mean that the PE that it deserves could be lower than 15 if all that it's doing is reinvesting everything in the business. So you can actually have a pretty high growth rate. Like you could be growing 8% a year, your business, you know? But if your returns are low, then that kind of growth doesn't really create a lot of value.
Yeah, sure.
Right? Okay.
Let's see. Cheesecake.
All right.
We talked about cheesecake recently, so listeners can... I went to Cheesecake Factory on Friday.
Okay.
And there was an hour wait. And I said, no, thank you. Goodbye. Okay. The Cheesecake Factory, currently trading 20 times earnings, EV to free cash flow 8 times, 10-year median returns, 18% on return equity, 20% on return on invested capital, 10-year CAGR in revenue, about 4%, going from $1.6 billion in 2010 to $2.3 billion in 2019. EPS has grown at around, rounding up, 12% over the past 10 years.
So what we would use here is enterprise value to sales, or market cap to sales, whatever we want to use.
Okay, why is that?
Because the sales for a restaurant are going to be somewhat cyclical. The margins are going to be somewhat cyclical, more cyclical in terms of margins than in terms of revenue because of economies of scale and diseconomies of scale at the site level in particular. And they're going to be very big for Cheesecake, right? So a small decrease in their sales has a big impact because they have very high fixed costs. You've been to a Cheesecake Factory, it's a very big place. It has lots of there's lots of employees that they are going to be relatively fixed. Some of it isn't that fixed that you can shift around, but there's other stuff that you can't. So rent, you can't. So what we'll look at then is the average, the 10-year median EBIT margin probably.
So 7.6%.
Right. So 7.6% is what we would want to use pre-tax instead of what it is most recently. Now, this is where things get complicated because some people are going to say, well, we should use the more recent numbers, which are poor. And the truth is, if that's the case, then if you think they're always going to be getting worse, then just like avoid the business. We can't do an intrinsic value estimate. But if you think they're going to mean revert, that's how we can do an intrinsic value estimate.
Someone's going to be like, no, you could put in your DCF and you could have it go up and discount it. And
so we're going to use the
I'm going to get crucified on Twitter.
So we're going to use an operating margin like that of like 7.5%. And then it's going to be, we take about 0.8 times that roughly, because that's roughly what the tax rate is now, is the inverse of that. So it would be 0.79. So you get that number, and then you get a number which actually is very close to what their free cash flow margin has been historically, which is 6.5%. Okay. That's very convenient, because what we're going to say is that their growth in revenue is like 3.5% or something, right? Okay, so if their growth in revenue has been like 3.5% the last 10 years, and we believe they can still grow 3 to 4% a year, I don't know that we do believe that, and we believe the free cash flow margin is 6.5% or so, then you have 6 to 7% of turning sales into free cash flow.
Yeah.
And remember, that's conservative a little bit because there's been a tax change, but let's put that aside. So 6 to 7% free cash flow and 3 to 4% in terms of revenue or something. It's very easy to see the correct intrinsic value is about 1x sales.
Okay.
Right? The reason why you can tell it's about 1x sales is we add up the free cash flow number and the growth number, which will be our growth and free cash flow. They're different here, right? So you see revenue grew more than free cash flow,
yeah,
but that's because margins declined during that period. So what you're going to get is that same thing. We talked about a hurdle of 10%. And this is the problem with the DCFs, right? Should we use 8% instead? What do we think it is going forward? We probably don't think the S&P is going to return 10% a year, but that's what we're using. So all of our numbers are going to change very meaningfully.
Yeah.
Like it could be a change of 25% in the intrinsic value of what we calculate based on whether we use something like a 10% number or something closer to an 8% number. It literally is going to make moves as big as that. So it's going to make a difference between if I say something's worth 1x sales or 1.2 to 1.3 times sales. So it's about 1x sales for this if it grows at 3 to 4% a year and has a free cash flow yield of 6 to 7% a year, because that hits right on at sales of 1x. That's hitting our hurdle rate of 10%. But if I lowered it to 8%, then you see that would raise the price we should pay. The intrinsic value would go up to like 1.2 to 1.3 times sales. So it's very sensitive to that. If some people are using like 6% or something that you could use, because there are estimates that the S&P 500 will only return 6% a year, because it's expensive. Well, if you use that, think about how far that pushes things up. Yeah. You're now getting things where you're over 1.5 times sales. So it's extreme.
Let's do one more.
Okay.
Let's see if any's. Let's go up. Do you want to do like an asset one?
Sure. Why don't we do Greenberg Partners?
Good old Dallas, Texas.
All right.
Greenberg Partners.
Greenberg Partners, I wrote up on the website, I think. Did I write it up or did you write it up?
No, you wrote it up.
Okay.
This was like one of the first companies we talked about.
Yeah. Go ahead.
Currently trading 11 times earnings, EV to free cash flow negative 19%, 10-year CAGR on revenue 13%, going from $416 million in 2009 to $624 million in 2018. They build homes in Dallas, Atlanta. I think they're in Florida now. I haven't looked at them in a while. But
yeah, the two original big markets for them were Dallas and Atlanta.
Yep.
Yeah.
Let's see what else. Yeah.
And literally probably even more around where we are right now than Dallas generally.
Yeah. Okay.
So the easiest way to do this one, which we don't see on QuickFS, the number, but is looking at the land inventory. So basically, we should price the stock based on how much it's growing its land. The reason for that being the best approach probably is that valuing a home builder on free cash flow, I think, is misleading, because we know with a company like this, or we think we know, they're not going to pay out dividends.
Yeah.
They're going to put it back into land, and land is an asset that can be sold and stuff, just like a bond portfolio or stocks or whatever. And yes, it's less liquid and whatever, but we can think of it that same way that we would look at an insurer or a bank or something. And so we can think of it like an investment portfolio. And so how much is it growing each year is an indication of how much the company's really earning, basically. Now we have to try to adjust that for like fair market value.
Yep.
In reality, the way that a home builder carries the land means that if the land goes down in value, they might mark it down, but if it goes up, they won't mark it up. And so if they buy land early on, like they bought some land in the right at the time of the crisis, for a few years it was underestimating the value of the company. I don't think it is anymore at all, but it was for a few years because land values had gone up by so much in between like 2009 and 2011. By the time you put a house on it and sold it, it had been a lot more expensive, right? So it would make sense to value it versus the land inventory, which again has a component of leverage to it, just like when we talked about Stella-Jones, which as a shareholder you have to take into account. You're buying the stock, so you have to take into account in terms of your intrinsic value estimate. Now, there's a risk to it, but you have to take into account that it's using leverage and you're getting the benefit or the harm from that. And so I would use the land inventory and then how much it's growing. So you could see a number here like... Again, we'd use something like a 10% number, right? So if we're using something like a 10% number, what people would normally do is, let's say we were using price to book, right? So if we're using price to book instead of the price to the land inventory adjusted for certain market value stuff, what we would do is we would take that number and say, okay, well, how much are they growing book each year, basically? And then compare that to our 10% hurdle rate, right? Or it could be an 8% hurdle or 6%, like we said. And that has a big effect on it. So that would cause a big expansion or contraction in the price to book ratio that we would value the company at, depending on the discount rate that we're using.
Yeah.
And so let's say that it grows book value by 10% a year all the time, and the market value and the discount rate we're using is 10%. Then you can see right there we'd value at price to book of 1 would be correct. Right?
Yeah.
Okay, that's the intrinsic value. However, you would see that if we used 8%, and maybe 8% is the more correct number, that value that you see of 1.2, that's actually closer to the intrinsic value. So that discount rate difference is like, so people might obsess about, well, is Greenberg Partners trading at a slight discount to book, a slight premium, whatever. Actually, whether you think the market's going to return 10% a year going forward or 8% is enough to move it like 25% in terms of versus book value. So while we obsess on things like price to book, it really depends on your discount rate. In theory, things should have a higher price to book if they're still growing like 10% a year on that book value as the discount rate that you're using goes down. And it has a very big impact, like I said. So like moving the discount rate from 10 to 6 or something has a huge impact to the point that you then say you should justify a really big premium to book value.
Now, a lot of the times when we value companies, we think about like what the business can grow over the next 10 years, right? So you kind of do it a little bit differently. I mean, you may be doing this in your head and thinking about different valuations, but the way you actually apply it sometimes in real life could be different than the way that you're describing it right now.
So I think the biggest difference is that I don't care what the intrinsic value of the business is. I don't think it's my job to have to figure out what the intrinsic value actually is. I think I just have to establish a number that is, I feel very certain the intrinsic value is greater than, and then that number just has to be a meaningful amount less than the share price. Okay. So basically all I have to do is, like, say, take OTC markets or something, right? So what I'm going to do with that is not actually try to get an estimate of what the value of the stock is. What I'm trying to do is, okay, given today's price, what would justify this? And
so you're doing like a reverse DCF.
Yeah, like I'm saying, how certain am I that they can grow at least 6% a year for the next 10 years? See, we could use 6%. We could do different numbers. 6% is convenient for this one because you see the PE. So the PE is like 26 or something. So we could do something like 6%, which means I don't count the cash as anything. Yeah. So I'm just putting the cash from the float, I'm putting that aside. So I'm not using EV, I'm using market value. And then I'm saying, well, if it can grow 6% a year for the next 10 years, then this stock will do as well or better than the market. And then I try to use a high discount rate.
So you flip it on its head.
A high rate, yeah. Whereas, see, if the market was very cheap now, then I would say I need more than that, yeah. So I flip it to say, how low a bar do I have to clear? And then you just want a very low bar to clear. And sometimes it's incredibly low. I mean, we bought a stock in the last year where the hurdle over 10 years, honestly, was just that it does not have a decline in earnings. It was justified with no earnings growth for 10 years. You would get a better than 10% return in the stock. But that obviously means the PE was like 5 or 6 or something crazy. Yeah.
Crazy cheap.
Yeah. Cool. Because the expansion from a PE of like 5 to 15 or something over time would get you plenty of return.
Then how does the company buying back stock affect it?
It would depend based on whether your intrinsic value is greater than or less than the price that you're paying. So we just went over a bunch of companies.
Yeah.
Omnicom buying back stock has maybe some slight positive value right now. Cheesecake Factory buying back stock maybe has more of a positive value. And then other things that we looked at, like Greenberg Partners, wouldn't really matter. I don't think we looked at anything that was incredibly, that looked to me to be incredibly overvalued. None of the things that we looked at seemed incredibly overvalued. But if a company was incredibly overvalued, then that you'd have a problem that way. I did a thing where I talked about Berkshire and stuff, and I would say that Berkshire paying out a dividend doesn't make much of a difference now. Just because I don't think Buffett can outperform, given the asset base and stuff that he has now, that much versus like what you could do with the money. But Berkshire buying back its own stock may make a lot of sense at times because the stock can still get very cheap. So like a buyback could have a ton of value in a way that a dividend can't anymore.
Cool. Well, that was great, Geoff. Good job. I want to thank everybody so much for tuning in with Geoff and myself. We are going to be in Omaha during the Berkshire meeting, which is the week of May 2nd. So if you are a prospective investor, like to learn a little bit more about our fund or the separately managed accounts, email me at andrew@focuscompounding.com. We'd love to meet up in person, maybe grab a cup of coffee. So definitely reach out to me, andrew@focuscompounding.com. And this is the first time you are tuning in with me and Geoff. Check out all of our work. Go to YouTube. We have 170 plus podcasts out there now, which is pretty crazy. Follow me on Twitter at Focus Compound. And if you like free content, join the Gannon Gazette on focuscompounding.com. I want to thank everybody so much for tuning in with Geoff and myself here today, and we'll see you in the next podcast. Hey, this is Andrew Kuhn, and that was the Focus Compounding Podcast, the podcast where Geoff and I talk about actionable stock ideas, investing concepts, and the overall way that we think about investing at Focus Compounding Capital Management. Go to focuscompounding.com and enter in your email to get a free watch list from Geoff every other week. And be sure to check out all of our other work where Geoff writes about stocks at focuscompounding.com. I upload how-to investing videos on YouTube, and we both manage capital for investors at Focus Compounding Capital Management. Thanks for listening, and be sure to subscribe to follow along.